So I am going to answer a question on Tecsys Inc. It's a company that we've answered a number of times in our Your Stock, Our Take segment in the past. There's not a lot of software companies in the Canadian market, so this is a company that has a good balance sheet, is earnings positive, does have some revenue growth. So we do get questions on it, and I'm going to go through it today. They are a provider of supply chain management software and related services. The company offers integrated suite of cloud-based solutions that are designed to help large and mid-sized companies in industries like healthcare, retail, general high-volume distribution businesses. They manage the complexities of their supply chains. The core offerings typically include warehouse management, distribution and transportation management, order management and fulfillment, so omni-channel there, supply management at the point of use, especially for healthcare, business intelligence and analytics. That's what essentially the software solutions that this company provides. So let's look at the stock price performance over the past year. As we said, it's down over 15%, so not inspiring performance there. Let's look at it over the past 5 years. It's actually down just over 3%, about 3.5%. Again, not good at all. So one would assume that the company's revenues are declining, but that's not the case here. This chart actually shows rather consistent upward trend in annual revenue for the company. It's not high-end growth, but compounding annually at about 9.42%. But it is growth nonetheless from around 123 million in 2021 to close out fiscal 2025 at 176.45 million. So that we have to say here, because of the declines, that must mean the company is losing money. That's not the case either. We do see this is EBITDA over the last 5 years, so there is positive EBITDA. This is and there is positive EPS as well. And we're going to look at the Q4 financials in a second. So the company's making money. It's not a terrible business, but the stock, again, is not performing. It does not appear to be a bad company. So why is the stock performing poorly? I'm going to look again right now at the last quarter, but the two main issues that I see with the business they kind of emerged in the last chart there I had up on earnings. That being a lack of per share cash flow or per share earnings growth. The second is valuations. Every time I'm asked to review Tecsys, I say it's a solid business with a solid balance sheet, but it's just too pricey given its growth rate. I have noted inconsistent earnings in the past as well. As Brennan has reviewed the company, he's noted the same thing. So let's get to this quarter. The last quarter, fiscal year 2025 Q4, SaaS revenue increased by 29%. That looks strong. SaaS subscription bookings were actually down. Were 6.5 million compared to 8 million in the fourth quarter of 2024. The remaining SaaS performance obligations increased by about 10%. That's decent. But total revenues of the company were just up in the fourth quarter to 46.6 million from 44 million. That is just 5.9% growth overall. Net profit, actually strong growth here, 12 cents per share compared to 2 cents in the same period last year. Adjusted EBITDA, also strong growth. But as we noted, and as you saw in the earnings chart there, fluctuative earnings over time, inconsistent and lumpy growth in the business. Again, they have a strong balance sheet, 31 million basically in net cash with debt basically zero. So they had guidance for the fiscal year coming up, 2026. Total revenue growth, 8 to 10%, about in line with what it's done over the past 5 years, maybe slightly below if it's at the 8 range, slightly above it's at the 10% range if it hits there. SaaS revenue growth looks solid, a little bit below the last quarter. Adjusted EBITDA, though, the margin is expected to be down over the previous guidance. And this is low for a software-related company. So let's look at those valuations. I hinted that they are high. As you can see here, the PE based on adjusted forward 2026 expected earnings is 81 times, around in that range. and the EV to EBITDA is 30 times. This is despite the stock kind of coming off over 15% over this year. So generally high multiples given the growth. Simply the conclusion here, it's a solid business, 10% compound annual growth on revenues. SaaS is increasing, but margins remain softer. At times in the software segment, we see some SaaS companies really foregoing profitability to try to grab market share. It looks like profitability, the margins are lower here. It could be that type of scenario going on. So buy or sell. Despite the share price slump, we're not buyers given the high valuations relative to the growth. And we have no position in the company now. But I think the company serves as a good example as we go through hundreds of companies right now on a monthly basis. We're doing a cash-rich report, which goes out at the end of the year. We end up going through over 3,000 companies in the Canadian market for that. Tecsys is kind of a solid reminder that even for solid businesses, you can't just pay anything or any multiple for the stock, or your returns over the mid to long term will not be strong. This company is traded at a massive premium. The growth is decent, but the underlying earnings have been spotty. They're making money over time, but the growth in terms of per share cash flow has not been there consistently. And now you're still being asked in these market conditions to buy this company at a significant premium. Now, there are forecasts into 2027 for them to have a jump forward in earnings. I have seen these about 2 years forward for the past 5-8 years. It's never been able to achieve that real jump forward in terms of earnings. If it can, then it probably deserves a higher multiple. Until it can, you're paying a premium for a company that is not growing earnings at the rate that would allow it to actually justify that premium.
Yeah. Like you had mentioned, I've looked at the company before and wrote a monitor report at the beginning of 2022 on the business. And at that time, these are trailing figures. So Ryan was citing forward. But at that time, it was trading at a trailing enterprise value to EBITDA multiple of about 36 times and a trailing price to earnings multiple of about 105 times. This was when the stock was trading around $40 per share or a little under that. So, just kind of close to the same place that it's in right now. And this, again, was after about a 30% or about 40% decline through the end of 2021 that we saw. Again, we saw that decline and it was still pricey. And, in this same report, we looked at VitalHub as well. I had written a monitor report on VitalHub at that time at, around $3. And again, it was a monitor report then, but we continued to track the business. It wasn't trading at absolute ridiculous multiples. But there's a business where, we eventually shifted into a buy. It was a great buy for clients. But we just, saw better growth at a reasonable price. And that's what we're looking for our clients.
Yeah. And I think the trailing price to cash flow on Tecsys right now is above 35. The trailing PE is 120 in that range, right? Juxtapose that to when we were able to buy VitalHub, it traded in terms of trailing and forward was lower, but trailing was around in the range of 10 times multiple. So less than a third of the multiple, with organic growth that was higher, with acquisition related growth that was higher. And you wait for the right time to buy a really solid company. Perhaps Tecsys comes in a range and starts to increase earnings that it looks more attractive. But to justify these multiples, they likely have to start growing at 30% plus. They're growing at 10% or lower, and they're guiding towards that. I think the business is a good business. It's very much needed in the supply chain segment. They do grow the top line. You're paying a significant premium, even though the stock has come down. So it probably is range bound between 25 and maybe 60 if it gets a bid and some excitement. They have a good quarter. but it sustainably grow from the $35. We're looking for a stock that trades at reasonable valuations that can grow from 35 to like $150 over a 5-10 year period. This company doesn't have the growth rate to get there at this stage.
Mm-hmm.
Yeah, and if you added 20-30% return onto this company, the valuations would then be extreme. So you need to see a significant pullback for you to have margin of safety to buy into a business like that.